Good day. Welcome to my first webinar. I will discuss an introduction to technical analysis. Topics include what is technical analysis, three most common chart types, line, bar, candlesticks, what is a trend, and support and resistance. Now let me present to you a case for technical analysis. Who among you have trading experience? Okay, one, two. Okay, I'm sure this has happened to you several times. So you wait for news or report to come out, then find that it is positive. Then when you buy or go long, the price drops, or vice versa. For those starting, you might wonder, why doesn't this happen? So you have to know what moves the market. It is people that move the market. You may read a lot of news from Bloomberg or CNBC, or read a lot of analysis from other traders who predict the price to go a certain way. But for the short term, these may not mean anything. But that's just for the short term. Because until someone makes a decision and actually place an order to buy or sell, the price won't move. My previous mentor, who was a technical analyst, says price is the only reality. If the price was $1 and it goes up to $2, so what is the price now? It is $2, right? No matter what the news says. So movement is based on people's perception of the news, their own opinion, their own analysis. Sometimes their state of mind, their beliefs, fear, personal circumstance, and profit taking. So it's actually psychology. Technical analysis is the mathematics of mass psychology. However, fundamentals matters the most in the long run. Fundamentals identify value, while technical identify timing. So there is actually no conflict between the two. While trading in Ashok, we will teach you to get the best of both worlds. We're going to teach you to think fundamental and trade technical. Technical analysis is a method of predicting the future activity of the market by analyzing its movement in the past. It is based on the assumption that price moves in patterns and trends, and history repeats itself. Also, if the market is on its way up, you can predict a pullback. Oh, so sorry for the spelling. And buy at a discount. Now on to charts. There are several kinds of charts, but these three are the most common. You have a line chart, bar chart, and the candlesticks. A line chart plots the closing prices at a given time. So if your time frame is set to 1 day, each point on the chart shows the closing price on that day. But within the day or within a time period, prices move up and down. A good strategist would like to see the price action real time within a given time period, so they can see the whole story and time their entries and exits accordingly. So that's where a bar or a candlestick chart comes in. A bar chart plots the opening price, highest price, lowest price, and the closing price on a given time frame. To understand how the bar chart tells a story, you can zoom in at one bar, like on this slide. You can see one vertical line and two horizontal lines, one horizontal line on the left and one on the right. Let's pretend this is the price action on a bar chart. of 1 day time frame. At the beginning of the day, the price opened at the level on the left over here. Then within a day, it can go up and down several times. The point on top is the highest level the price reached on that day, while the point at the bottom is the lowest price it reached on that day. And when the day ends, the bar on the right stops moving, and that's where it will show where the price closed. If the bar is bullish, the close is higher than the open. If the bar is bearish, the close is lower than the open. Bar charts look differently depending on where the price opened and closed. So it doesn't always look like this on the slide. A candlestick is similar to a bar chart but has a solid body with color. A bullish candle has a different color from a bearish candle. So the candlestick also plots the opening high, low, close, but has a solid body. Back in the days where trading weren't done in computers, chartists plot their charts on paper. A wide-bodied candle means it is bullish, so the price opened at the bottom of the body here and closed on top of the body. And a bearish candle was shaded black. The opening price is at the top of the body and the closing price is at the bottom. And when trading was done in computers, you can actually place colors. Sometimes the green candle represents a bullish candle, while the red one represents a bearish candle. The lines above and below the body are called shadows, or some call it wicks. Like the bar chart, it plots the highest and lowest point the price reached on that given time frame. Now let us discuss trend. Price move up and down every second, and it would be a challenge to make buying or selling decisions based on its real-time movement. So you got to know the trend. It can generally move three ways: up, down, and sideways. An uptrend has higher highs and higher lows, as you can see on this chart. Prices move up and down, but a general direction, but has a general direction, sorry. If the highest points are getting higher and the lowest points are getting higher as well, it is an uptrend. So here you see higher highs, there's a high here, and then the highs get higher, highest point gets higher, highest point gets even higher. The lows are also getting higher. There's a low point here, went up, went down again. This low is higher than the previous low. This low is higher than the previous low. So this shows an uptrend. The opposite happens on a downtrend. The highs are getting lower and the lows are also getting lower, as you see here. So the high here is lower than the previous high. The high here is lower than the previous high, so on and so forth, as well as the lows. The lows are also getting lower. On a flat trend, the highs and lows are flat, as you can see here. You can actually draw lines connecting at least two highs together and another line connecting two lows together, as you can see here. And when you do that, you get support and resistance. A support is a previous area of buying demand, and it prevents the prices from going further. So support is at the bottom. So it went down to this point, It went up again, it went down again to that point. It was a previous area of buying. So this is where the demand is. And you can plot, draw a line connecting two of those together and extend it. And when this price actually falls, you can expect it to fall down in this area where the support line lies. Resistance acts similarly. It's the line on top. It prevents it's a previous area of selling supply. So whenever the prices touches that line, people sell, it goes down, touches that line again, people sell, goes down, touches that line again, people sell, like that, goes down again. So when the price is going up, you can actually predict that it can go up only until resistance, unless it breaks, of course. And once support line breaks, previous support becomes the new resistance. And once the resistance line breaks, previous resistance becomes the new support line. As you can see here, in this area, this line acted as resistance. So when it went up, came down, went up again, came down, but when it broke, it stayed on top. Then it broke again. It became the resistance line again. So when it went up, it bounced back down, went up, bounced back down, and when it broke, the previous resistance line became support. So it bounces up whenever it touches that line. So this is where we end the webinar. It's very basic. Maybe on a future webinar we can discuss more details and include some patterns. Thank you.